Hey fellow traders. In today's video, I've got kind of an idea. Big shout out to Lance Johnson 4774 for kind of spawning the idea of this video. Basically, I want to get a little bit more in depth about the latest video that I've put up about the secret in plain sight. If you're new to the channel, please leave a thumbs up and subscribe and hit the bell for the notifications. I'm going to be doing some live sessions where basically I'm going to be trading and talking about trading, so you can ask your questions in the comments of the videos or the actual live sessions, and I'll try to answer those as I can. But in today's video, we're going to talk about how to set up a possible use for that video, for that idea in that video, and show you kind of a simple strategy to kind of help you get a feel for working with it if it's something new that you're kind of coming into. I'm sure probably most of you are probably coming into this idea pretty new. So let me go ahead and first start with the risk setup. I know it's probably a common thing to hear that oftentimes, traders that are professional, they will risk 1%, but they will typically only lose a quarter percent, or they're actually only risking a quarter percent, is another common way to put it. And really, basically, this is what they're talking about when they're talking about professional traders risking very little or losing very little. So, what we're going to get into first is the risk setup. The common thought train is to use 1%. So, I'm going to set this up based on a 1% account. And I'll leave a link for this calculator in the description of the video as well. But basically, what I've got set up is I've taken an example of, say, you're using a US dollar based account, you're trading the Euro USD like I typically do, and I've got it set up for the Oanda uh, current account settings, which is $10 round trip with $50 or 50 times leverage. So we're going to start by figuring out our risk calculation. We look over here, the commission as pips has already been converted, so 1 pip will be the commission at any size of the trade. So I've accounted for that in the stop size so we can actually get a size, but it would show us that our lot size would be a 0.01. And although that sounds kind of small, these 0.01s can be pretty powerful if used correctly. And the main reason being is that profits are the benefit of proper risk management. So a lot of my focus tends to be only on risk management. I don't so much really look at targets because targets can induce greed. So I just mainly manage the risk. Another reason being is if you have nothing in the risk, you can't trade. So always try to focus on preserving that capital. So with that in mind, I've taken a standard 40 pip stop, and that's how you're going to divide that into 10 pip sections. And then what we're going to do is use that. So we're going to risk $4, including our commission, on a 39 pip stop. And that way, worst case scenario, we lose $4 out of this account, or 1%. So that would be a standard risk setup to use something like that. If you're going with 300, you may want to use a 30 pip or a 29 pip. Or if you're less than 300, I typically kind of recommend using a set dollar amount. So you may want to risk $3 to $4 per trade. So if you have a $100 account, $3 to $4 a trade, you still get several opportunities to try to make money without drastically hurting your account. So that's going to be the basis for proper risk management, and then we'll get into the strategy to show you kind of how to tighten up on that risk management. So to go ahead and go over the numbers that we're looking at, we have no break even distance. We're going to be required to hold 21.55 in margin in this account. So you will need at least $25 to $30 to start trading in that account if you choose to sign up with Oanda. Not affiliated, no sign up pitches or anything like that, but uh, they are a reliable broker. Good friend, been with them for over a year and a half now, so they're a very good broker, I can say. So let's go ahead and get into a strategy part and take a look at how we're going to apply this strategy. So the first things first, we're going to go ahead and calculate the risk in this calculator. If you're not using the calculator, and grab the widget from my TradingView profile. I'll leave a link for that as well. But I've gone ahead and set that up in points, 400 points, that's 40 pips. And I'm not really worried too much about a reward ratio. I've set the account up to $400 and we're going to risk 1%. This calculator does not yet include commissions. I'm going to get to the coding here before long. I've just got so many things to do, but I will get that updated. And right now it only does Forex, but I've got a couple videos covering this and I'm going to show using this as well. But that's how I've got it set up. In this area, you've got the display settings and such. Everything has information. So if you want to check that out, I'll leave a link for it below. Just to show you kind of what it can do real quick, I did have this pulled up. So you'll find this on my profile. This is basically the different layouts, what it does, and a little bit about it. So I'll leave a link so you can check that out. So let's go ahead and take a look at the strategy part. So what got mentioned in the comment is you sort of have like a market structure style strategy. So let's say you're looking to basically look for retracements that kind of go to the most recent high or to some very definite support level if you were looking to go long. And let's say price came down here and you hit the buy button right here. Now you go ahead and you set up your stop to be 400. Well, we'll say 39. And that will give us a less than 1-to-1 reward ratio, but that is not what we are intending to ever let happen. So basically, we're going to try to ride this up to a new high. Let's say we've got another level up here around like the 1084, 1085 or something that we're going to try to make it to. So right now we buy at 1086 and we're looking for about 60 pips or so. So that will eventually give us our reward if we're looking for that and do eventually get that. And we feel like in the long term, the market looks like it's going to reach that. So we set in our trade with that 40 pip stop. Now, if in fact the price does start to move in our favor and move up, you can most certainly trail your stop up to start protecting and locking in your gains. But in the early part of the trade itself, you'll probably not want to do that because you'll want to give it some room to breathe. You don't want to get knocked out by a liquidity run or something simple like that, which is kind of the main purpose of why you would want to take a look at using this type of setup. But really the main purpose of this and the main use of this that you'll find yourself doing 90% of the time is price will start to come up. Let me make that a little bit thicker so we can see it. Price will start to come up and then it will start to maybe flirt with the high, stall out a little bit, and then all of a sudden it drops. So now all of a sudden you're in a situation where your position is no longer positive and maybe you chose not to move your stop up, or maybe this is just a very short range. You maybe don't want to take that little small bit out just simply because of it being such a small distance. It's only 6.7 pips. So let's say you didn't want to take that example, and now all of a sudden the market's starting to move against you. You're starting to get a bit of a double top right here. So it's starting to show that maybe it may not retest, it may not. And then you observe the market just a little bit longer, and now all of a sudden we've broken this low over here. And that was basically what you would consider a trade invalidation. So normally you may have your stop here and it would be really tight and get caught in a liquidity run and price could just shoot back up. But let's say, for example, the market is kind of dipping down and then now it starts to pull back and is kind of doing this thing where it's creeping up really slow. So now what you would want to do is you kind of understand that normally these type of strong pushes down with the slow rise back up, typically that previous support will become resistance. And we now have our position very close to where price is at this point. So we are risking barely more than the commission, maybe even less if we're working with a spread. I know with Oanda we usually have a 5 to 6, maybe 7 point spread at times. So we'll just say we're looking at something like this. So That would be our full cost of our trade, and now price is pulled back in. Now all we do is nix that position and wait to see what the market is going to do, and we lost next to nothing. So we've only lost maybe 1 or 2 pips, so we really only technically lost like a 0.02% that time. And now all of a sudden the market just tanks. And look, we don't hit our stop. We didn't incur a hard loss. And we saved all of our risk. And now we could even potentially go short in this position and start looking to try to recoup our, you may jump in on the breakout. You do the same thing with your stop. That's the wrong side. There we go. You may decide to jump in now, and you do the same thing with your stop and your targets. And then now you may end up actually getting a good run out of the market to where it comes back down to this level, and now you've actually made a complete profit of around 28 to 29 pips, 23 pips. So you gave up a couple of pips, but now all of a sudden you quickly changed direction, and boom, you caught that drop and caught that 23 pips. You didn't have to recover very much at all because you were very choosy about where you closed your trade. You tried to wait just a little bit and be patient for price to come back near this level, and then you nixed it, and now all of a sudden price is starting to make a run, a break. Maybe this might be an opening session time or something, somewhere right in here, where it may be the start of the New York and this is the pre-market buildup or something, and you go ahead and nix your position kind of close to this area. Now the market opens and really starts to plummet, so you jump in and get in. So that's how you can apply market structure to actually manage your position with this type of risk setup. And then even worst case scenario, if you closed it here, now we're only looking at our 1/4% risk because we're about 10%, or we're at 10 pips out of 40. You divide that together, that's a 1/4% or 0.25%. So even right there, you could decide to nix it just because it's certainly showing a plummet and you don't trust it's going to pull back. So now you've only lost a 1/4% instead of the full 1%. So that would be a full application of this strategy and a little bit of use of how you may apply it and how you can actually manage your position and manage your risk to try to preserve as much capital as possible when you're not correct. Now, you definitely want to get some type of confirmation, like a close below this level, or maybe some slowdown or weak candles here, and then you see the consolidation. So you definitely know this invalidation is correct. So then you could even close it around there, around this area here from your entry, so then you can only lose around about 5 pips or so. So that's going to give you like 0.15% risk loss. The less risk that you're able to lose in the current situation, the less you have to recover on the next trade, and the more that actually ends up being profit for you. So that's the main idea of the application. Now, if you have difficulties with closing out a position, taking a loss, or holding a position to try to manage it and still remain calm while reading the market, if you're having difficulties with that, this may be a method that is not right for you. You may want to stick with a set stop loss and try to trail that up. Typically, the way I'll use a trailing stop loss is I will wait for price to go up, and if I have my trade, for example, around here because of whatever reason, I'm using a standard like 16 to 30 pip stop, 25 pip stop, then basically let's say I come here and I think that, okay, the market's going up, then I would let the price ride up, and then once it comes down, makes a new high. Once this next high gets broken, that's when I would then consider placing my stop here, and I would lock in that small portion of gains here, which puts me above my break-even cost. I would take a little bit of gain, even worst case scenario. So should the market just drop out and I'm not paying attention, at least I keep that much, and also account for slippage, because sometimes when you go and put your break-even point exactly on the point where it's only a few pips or so, or a pip just to cover that commission and spread, that slippage may end up putting you down here. So I always try to get, even worst case, I try to get a few more pips more than break even if I am bringing a stop into play, because we had this break of the market structure here and we pushed to a new high. So I want to bring it somewhere close to here or below here. If we're seeing a bunch of wicks then off the candles or so, then you may want to consider just putting it a little bit below, just in case there's some type of liquidity grab and then it goes up even higher. And then in that case, then you'll wait for it to do something like that. Test that high, test some support as legitimate, and then you would go ahead and move up to there and end up locking in some more. So that's one way you can actually uh, use this to move forward with applying your own little uh, trailing stop system. If you want to try to practice and use a trailing stop, you're just going to look for these breaks in market structure. And every time it breaks, maybe retest, does a little liquidity grab or so, retest and break, then you can trail that stop up and you can actually wind up getting sometimes even 100, 120, 130, 180 pips out of just a small position that you risk maybe 30 or 15 pips on. So you can get a fairly good ratio with that. And one good way that can help you manage that is by looking at the higher time frame. I always recommend trading into the higher time frame, and that's what I mean. You're actually analyzing and looking at the higher time frame at the 15-minute or the hourly, and you may even be looking to see if the hourly is going to respect one right above it, just for some extra confirmation. But if the 15-minute is showing uptrend, even if there's a sharp run down, it's very possible that it's just a liquidity run. It could very well push back topside. So that's another way you can apply that strategy that we talked about below with a little bit wider stop, because sometimes it may just pen down because of a news event and then shoot right back up. So uh, that's just one thing to manage and look at. So instead of coming to that very short, 10, 15, 16 pip stop, get pinned out and go, you could consider using that wider stop, maybe using a little bit lower risk. And then when it tries to pin everybody out, making a little liquidity run for this stop point here, and then all of a sudden it shoots up. That's going to be a very quick, like 2 to 10 minute move sometimes, and it will wind up usually forcing a very strong move in the opposite direction when you see these very strong pins. So that's something to just keep in mind when trying to apply that strategy. Mainly, that's what that strategy is trying to avoid, are these huge pin bars. They do happen quite frequently around the London Open and New York session. Sometimes you'll see those on the Euro USD. Once you have a little bit of experience, you'll be able to pick out certain patterns in the times when institutions and market makers like to run for these stops and then suddenly launch it the other way. And this also works on shorter time frames as well. You can have multiple liquidity runs throughout a session. So just something to keep in mind. I mean, you have to have a lot of orders to move the market quickly. So in order to get those, you have to take out other traders and take what they have. So that's just a little bit of order flow thought to keep in mind. So when you're looking for, uh, you know, possible liquidity spots, now you get that pen into the liquidity. The liquidity then gets wiped out, but all of that liquidity is now owned by whoever's moving the market, and boom, it just launches. So something to look out for, maybe something to wait for as a signal for entry. If you see one of these runs and then it closes high, continues to move higher, that may be a good sign to jump in and ride that, because that is a clear sign of momentum if it makes a pin and then starts to rise and continue up strongly. So just a couple of tips there on using market structure to your advantage, so you can try to possibly win more trades and manage your risk to lose a little bit less should you run into a worst case scenario. And that's going to finish it out for this video, traders. I'll catch you on the next one. Market's a little slow this week, so I'm thinking I might just go live and do a practice session. I'm still working on training up for the 5K challenge, maybe even taking a 100K challenge potentially in the future. May even just go ahead and start a new 5K challenge sometime in within the next 7 to 10 days, and I'll basically live stream the trades on that one too, so you guys can watch and see how I'm managing and trading that. But I'm going to end this video for now and keep that from getting too long. But I'll catch you on the next video.